Hi, I'm Roxy. Welcome to the Trading Floor's Futures Trading course. In this comprehensive course, I'll provide you with a thorough understanding of futures trading. You will learn essential concepts like what are futures, how and where to trade them, risk management techniques, and the trading floor's strategies in the futures market. Later in the course, I'll show you how to set up a demo account and how to take trades. By the end of this course, you'll know better if futures market is a good fit for you and how to trade futures. Let's get started with Module 1, Introduction to Futures Trading. Welcome to the Trading Floor's Futures Trading course, Module 1, An Introduction to Futures Trading. In this module, we will explore the history of futures, unique characteristics, and the diverse group of market participants that drive this dynamic and ever-evolving market. History and development of futures trading. Futures trading has a rich history that dates back centuries. It finds its roots in ancient civilizations where farmers and merchants engaged in forward contracts to protect themselves against price fluctuations of their crops and goods. However, the formal development of modern futures trading began in the 19th century with the establishment of the commodity exchanges, such as the Chicago Board of Trade, CBOT or CBOT, in 1848. These exchanges provided a centralized platform for standardized futures contracts, laying the foundation for the futures market we know today. Since then, futures trading has expanded well beyond its agricultural origins. It now encompasses a wide range of asset classes, including financial instruments, energy products, metals, currencies, and much more. The advent of electronic trading platforms has further democratized access to these markets, enabling traders from around the world to actively participate. Key differences between futures and other instruments. Futures trading offers distinct characteristics that set it apart from other financial instruments, such as its contractual nature and that it's exchange traded. Let's dive into these differences. Its contractual nature. Futures contracts are standardized agreements that obligate both the buyer and the seller to execute a transaction for a specific quantity of an underlying asset at a predetermined price and date in the future. This standardized structure provides transparency and efficiency in trading. Futures are exchange traded. Unlike some other financial instruments, futures contracts are exchange traded. This means they are bought and sold on regulated exchanges, ensuring transparent price discovery and fair execution. I'll later on describe how this affects things like spread and slippage and some of the benefits of futures being traded on a centralized exchange. Another example, leverage and margin. One of the most notable features of futures trading is the use of leverage. Traders are required to post a margin, which is only a fraction of the total contract value. This allows market participants to control a more substantial position with a relatively small upfront capital investment. While leverage can amplify profits, it also magnifies potential losses, making risk management essential. We'll go into more about risk management later on. Settlement methods. Futures contracts have different settlement methods depending on the underlying asset. Physical commodities, like agricultural products and oil, may result in actual delivery of the asset. In contrast, most financial futures, such as stock index futures, are settled in cash, where profits or losses are transferred between traders' accounts without any physical exchange. Let's discuss futures versus options. One of the critical distinctions in options trading is the concept of time decay. As options approach their expiration date, their value can erode rapidly due to time decay, also known as theta decay. This feature adds an additional layer of complexity to options trading, whereas futures don't have the issue of time decay. Another example, leverage and account size. Leverage and accessibility play an integral role in both futures and options markets. Options and smaller accounts. Options contracts allow traders to control a significant underlying asset with a smaller upfront investment. This characteristic makes options trading accessible for those with smaller trading accounts, enabling participation without expensive capital. Similarly, futures trading also caters to traders with smaller accounts. The margin requirements for futures contracts often provides higher leverage, allowing traders to manage more substantial positions with limited capital. This is where futures has a similar benefit to trading options, but again, without the issue of time decay. Now let's take a look at Forex versus futures, comparing these two. Centralized exchange versus decentralized market. Forex trading occurs in the decentralized foreign exchange market, where currencies are traded over the counter. Futures trading, on the other hand, takes place on a centralized exchange like that provided by the CME Group. Regulation and transparency. Futures exchanges are regulated entities, ensuring transparency, standardized contract specifications, and a level playing field for all participants. The Forex market lacks centralized regulation, leading to varying degrees of transparency and risk. Traders can see wildly varying spreads, commissions, and slippage on their orders in the Forex market. We'll go into the benefits of trading a regulated centralized market later on in the course. Let's discuss market participants. Who is trading futures? The futures market is a diverse arena with various types of participants, such as hedgers, speculators, banks and institutions, and retail traders. Let's look at each. Hedgers. These are individuals or businesses that use futures contracts to manage risk and protect against adverse price movements in the underlying asset. For instance, a farmer might use futures to lock in the price for their crops before harvest, safeguarding against potential price declines. Speculators. Speculative traders engage in futures trading solely in profit from price movement without any intention of taking delivery of the underlying asset. Speculators assume risk in the hope of capitalizing on favorable market trends. Banks, institutions, and hedge funds. Large institutions and corporations participate in futures trading as an integral part of their regular business operations. They may use futures contracts to manage inventory, hedge production costs, or mitigate currency exposure arising from international trade. And finally, retail traders. Thanks to the rise of online trading platforms, individual investors have gained access to futures markets. Retail traders participate in futures trading for various reasons, including diversifying their investment portfolios, generating additional income, or seeking speculative opportunities. Congratulations on completing Module 1 of the Trading Floor's Futures Trading course. You now have a solid foundation in the history, characteristics, and market participants of futures trading. In Module 2, we'll explore the exciting benefits of trading futures, discover how futures offer a regulated market, tax advantages, and opportunities for traders with smaller account sizes. Module 2, Benefits of Trading Futures. In Module 1 of the Trading Floor's Futures Trading course, we laid the groundwork by exploring the history, unique characteristics, and market participants of futures trading. Now, in Module 2, we'll delve into the benefits that futures trading has to offer. Let's dive into the advantages of trading futures. Advantages of trading futures in a regulated market. One of the primary advantages of futures trading is that it takes place in highly regulated markets. Regulated exchanges such as the Chicago Mercantile Exchange, or CME, and the Intercontinental Exchange, ICE, ensure transparency, fair pricing, and the smooth functioning of the markets. These exchanges have strict rules and oversight, providing traders with confidence in the integrity of their transactions. Moreover, the clearinghouse mechanism employed by futures exchanges reduces counterparty risk, as the clearinghouse acts as an intermediary between buyers and sellers, guaranteeing contract performance and pricing. For you, that means less spread hikes or widening, and that awful massive slippage. Precision exits and entries are much more possible and likely in a regulated market like futures. Now, for the tax benefits associated with futures trading. Futures trading offers unique tax advantages compared to other forms of trading. Profits and losses in futures trading are often taxed at a more favorable rate known as the 60-40 tax treatment. Under this tax treatment, 60% of futures gains are taxed at the lower long-term capital gains rate, while the remaining 40% is taxed as short-term capital gains, subject to an individual's ordinary income tax rate. This tax treatment can significantly reduce the overall tax liability for futures trading, making it an attractive option for tax-conscious investors. This applies to U.S.-based traders for application of the U.S. tax law and requirements. If you are trading outside the United States, please look into your own country's tax laws for how futures gains and losses are taxed. Ability to trade with small account size. No pattern day trading rules. Unlike certain equity markets, think the stock market, futures trading allows individuals to participate even with a smaller account size. The use of leverage in futures trading enables traders to control a larger contract value with a relatively small amount of capital. Additionally, futures trading is not subject to the pattern day trading rule, or PDT rule, which requires equity traders to maintain an account balance of at least 25,000 US dollars to regularly execute day trades. This exemption in futures trading allows traders with smaller accounts to engage in more frequent intraday trading without the capital constraints imposed by the PDT rule. So, hearing some of these benefits, you may be wondering, can I trade futures outside the United States? Absolutely. While the focus of this course is primarily on the U.S. futures market, futures trading is a global phenomenon. Futures brokers support international traders, providing access to the U.S. futures exchanges. Additionally, many countries have their own futures exchanges where a diverse range of commodities and financial instruments are traded. Some of the prominent international futures exchanges include the Eurex Exchange in Germany, the Tokyo Commodity Exchange in Japan, and the Multi-Commodity Exchange in India. These international exchanges and access to the U.S. futures exchanges provide a broad spectrum of trading opportunities to traders worldwide. Module 2 has highlighted the numerous advantages of trading futures. Regulated markets provide transparency and confidence, while tax benefits can enhance profitability for traders. The ability to trade with a smaller account size and exemption from pattern day trading rules open doors to a broader range of individual traders. As we move into Module 3, we'll explore various futures exchanges and the tradable assets or instruments they offer. From agricultural commodities, financial derivatives, you'll discover the diverse opportunities available in the world of futures trading. Welcome to Module 3 of the Trading Floor's Futures Trading course. In this module, we will explore futures exchanges and the diverse array of instruments traded on these platforms. An overview of major futures exchanges. Futures trading takes place on several major exchanges worldwide, each offering a unique selection of contracts. We're going to focus this course on the U.S. futures market. Some of the most prominent exchanges include the Chicago Mercantile Exchange, CME, part of the CME Group, and the Chicago Board of Trade, CBOT or CBOT, in the United States, known for their vast range of financial and commodities contracts. There's also international futures exchanges. The Eurex exchange in Germany is the leading European derivatives exchange, and the International Exchange, ICE, also located in the United States, is well known for a variety of futures contracts. Each exchange has its strengths and focuses, providing traders with a wide variety of opportunities. Let's start with the Chicago Mercantile Exchange, part of the CME Group. Though not the oldest exchange, that distinction goes to the Chicago Board of Trade, or CBOT. The CME Group is the largest and most prominent exchange. CME Group was formed through the merger of the Chicago Mercantile Exchange, CME, and the Chicago Board of Trade, CBOT, in 2007. This followed with the acquisition of the New York Mercantile Exchange, or NYMEX, in 2008. The group's headquarters are located in Chicago, Illinois. The Chicago Mercantile Exchange, or CME, was established in 1898. CME offers an extensive range of financial and commodity contracts, but it has a primary focus on financial assets, including stock indexes, for example, S&P 500 and NASDAQ, known as ES and NQ futures. The foreign exchange currencies, Forex. Yep, you can trade Forex in futures too. The futures currencies are focused on the US dollar currency pairs. Think Euro US dollar, that's 6E in futures. There are also Japanese yen, British pound, Australian dollar, Canadian dollar, and Swiss franc. Each of the futures currencies focused on Forex are designated with a 6 followed by an alphabetical character, such as the Australian dollar, which is 6A, and the Euro dollar 6E. If you like the cryptocurrencies, the futures marketplace now has Bitcoin and Ethereum futures, so definitely check those out if you like trading crypto. While the CME Group offers energy contracts, the New York Mercantile Exchange is the subsidiary. It's the primary exchange for energy futures, and we'll cover that shortly. Remember, CME Group is a large controlling exchange. I'll show you a bit of the information offered through the CME website later on in this module. Let's discuss the Chicago Board, or CBOT. It was established in 1848 and holds the distinction of being the oldest futures exchange. With a historical emphasis on trading a diverse range of assets, CBOT is renowned for its agricultural contracts involving commodities such as corn, soybeans, wheat, and soybean oil, as well as livestock like live cattle and feeder cattle. Furthermore, CBOT plays a pivotal role in the realm of financial instruments, notably specializing in interest rate derivatives such as the Treasury bond and Treasury notes. Now for the New York Mercantile Exchange, which is a subsidiary of CME Group. It has its origins dating back to 1872. It stands out as the leading exchange for trading energy and metal contracts, encompassing a diverse array of assets, namely energy resources including crude oil, natural gas, and heating oil, metals encompassing gold, silver, copper, platinum, and palladium. So if you enjoy trading gold, for example, then this would be the futures exchange for you. Let's look at the Intercontinental Exchange. Established in 2000, ICE has emerged as a notable player in the realm of commodities futures trading. Unlike the other exchanges, ICE is based out of Atlanta, Georgia. It provides a wide spectrum of contracts focused on soft commodities like coffee, sugar, cotton, and cocoa. These major U.S. futures exchanges exemplify the multifaceted landscape of futures trading, catering to a broad spectrum of assets and interests. The Chicago Mercantile Exchange, the Chicago Board of Trade, the Intercontinental Exchange, the New York Mercantile Exchange stand as pillars of innovation and evolution in futures trading, offering a diverse array of contracts for traders worldwide. As you can see, the futures market covers a diverse range of asset classes. These include commodities like gold, oil, corn, and coffee, offering traders exposure to the raw materials that drive the global economy. Currencies futures allow traders to speculate on the exchange rates between different currencies, while index futures track the performance of a particular stock market index. Additionally, interest rate futures, equity futures, and various other financial derivatives add to the richness of futures trading. Let's touch on the advantages and risks of trading different futures markets. Different futures contracts offer unique advantages and risks. Commodity futures, for example, provide diversification and a hedge against inflation. Currency futures offers opportunities in the global foreign exchange market. On the other hand, financial futures allow traders to speculate on market movements without directly owning the underlying assets. However, it's essential to be aware of the risks associated with each instrument, such as market volatility, geopolitical events, and changes in supply and demand fundamentals like seasonality of agricultural assets. An important note are the market hours and overnight markets, and the margins associated with trading futures. Futures markets have specified trading hours, offering ample opportunities for traders to participate during active periods. However, some futures contracts also have extended trading hours, commonly known as overnight market. During these extended sessions, liquidity may be lower and price movements can be more pronounced. Overnight margins are reduced margin requirements set by brokers for holding positions during the overnight trading session. These lower margins aim to accommodate traders while markets are closed. It's important to remember that even with lower margins, there can still be significant price movements, so risk management remains crucial during overnight trading. Additionally, understanding margin requirements is crucial in futures trading. Margins act as collateral to cover potential losses, and overnight margins may differ from regular trading hours. This may require traders to manage their positions diligently, as well as brokers having different account size requirements affecting how you manage risk and the number of contracts you can trade during the overnight market. Okay, this is the CME Group website. Again, the CME Group is a combination of different exchanges combining CBOT, NYMEX, and CME. So here, as you navigate the website, you will be able to find information out about all of the different products traded on those exchanges. If we go right up here to markets, that's why you can see commodities that you would expect to see, for example, on the CBOT. You will see financial instruments here that you would expect to see in CME. And you will also see, for example, the energy and metals that you would expect to see on NYMEX. The great benefit provided by accessing this CME website is that you can find individual details that are quite helpful to understand each one of these instruments that you can trade. Let's jump into a couple of them and see what information is available, such as the S&P 500 E-mini. Here they provide you with the current contract information. So here you can see that if you were to look up in, for example, TradingView ESU3, that would be the contract code. This was the last price that was traded. You can see that the overall instrument is up 1.48%, and you can see the volume that was traded today in the market. It gives you a quick overview here about this particular instrument. And then if you scroll down, you can see this Explore this product in depth section. And this will show you that each one of the contract units price point is $50 per point. It's traded in US dollars and cents. And you can see that the product code, if you were looking for it in the exchange, is ES. They also provide here the trading hours through the CME exchange. Here as well, you can see daily volume totals for each one of the days of the month here that this contract has been traded. Okay, so clicking on margins brings you to a page that explains that the CME exchange, being the centralized exchange that it is, requires brokers to have a maintenance of at least this much for their margin maintenance. If you click on specs, you will find additional contract specifications. This again is mostly just that same information I showed you on the first page, but does provide you with that breakdown of each quarter point for a full ES contract, provides you with $12.50 in profit or loss, depending on the direction that you're particular trade is going. So being the exchange for trading this particular futures product, they are the authority. So any information that you need to find out about how this exact product is traded through the exchange is available here on the CME website. Let's take a look at one more product. Let's jump over into corn futures, for example, which again is a commodity traded through CBOT. So here you can see it clearly trades lower volume than the ES futures. ES and NQ futures are two of the top traded futures products. Here's the code. Here's how much it changed today. A little bit of information about the corn futures. This would be up-to-date agricultural news that the exchange finds to be valid and relevant. And then scrolling down, you can see the explore the product in depth. You can see that each contract unit is referring to 5,000 bushels. The contract is traded as ZC. Here are the contract hours. And here you can see again the volume that was traded. Let's jump over to one more. And now gold futures. You can see how much the gold futures changed today. You can see the volume that was traded in gold futures. You can see its code. Little bit of information about it, relevant news, and then the explore the product in depth section tells you that it's 100 troy ounces for each contract. That is what it is representing. GC is the designation for the gold futures contract. Here are the hours that is traded, and again, the volume. If we jump over into specs on this one, you will see that instead of a quarter point, it is traded in tenths of a troy ounce, and for each tenth, it is $10 in value. Okay, as you can see, any type of futures product, instrument that you are interested in trading, you can come over here to the CME Group website and get some detailed information about the trading hours and the price fluctuation, so the amount that each one of its incremental ticks or points is worth, as well as the news information and volume traded and current contract information. All this information can be very helpful to you as you are exploring which of the different instruments you're interested in trading. Module 3 has provided a comprehensive overview of futures exchanges and diverse instruments they offer. The major exchanges such as CME Group open up a world of possibilities for traders. Whether you are interested in commodities, currencies, indices, or other financial derivatives, futures markets cater to a broad range of interest. As we move into Module 4, we will delve into the essential aspects of futures trading, contract size, specifically micros versus minis. These contracts cater to traders with different risk appetites and capital sizes. Understanding the nuances of micro and mini contracts will enable you to tailor your trading approach to suit your individual goals and preferences. Welcome to Module 4 of the Trading Floor's Futures Trading course. In this module, we will explore the significant differences between micro and mini futures contracts and how they provide excellent alternatives for small traders. Understanding these contract sizes is essential for effective risk management and implementing various trading strategies. Understanding the difference between a micro and a mini futures contract. A quick history of futures contracts. Using ES futures as an example, micro and mini contracts for the ES futures, or S&P 500, were introduced to the market to enhance accessibility and cater to a wider range of traders. The E-mini S&P 500, a pioneering mini contract, was launched by the Chicago Mercantile Exchange, CME, on September 9, 1997. Its smaller contract size aimed to make trading more attainable for retail investors and offer a gateway to the futures market with reduced capital requirements. Building upon this success, micro contracts, including the Micro E-mini S&P 500, were later introduced on May 6, 2019, further democratizing futures trading by providing even smaller contract sizes. These innovations revolutionize market participation, empowering traders with varying capital levels to engage in the dynamic world of equity index futures. Micro and mini futures contracts provide traders with tailored options to engage in the futures markets while accommodating varying levels of capital and risk tolerance. Micro contracts offer a gateway for retail traders with limited funds, allowing them to participate in the market with smaller contract sizes. For instance, the E-micro S&P 500, known as MES contract, represents just a fraction of the standard E-mini contract, granting traders exposure to market movements without the need for substantial investment. On the other hand, the mini contract strikes a balance between micro and standard contracts. With a size larger than micros but smaller than a standard contract, they offer traders a middle ground for managing risk and seeking potential profits. Many contracts provide a meaningful level of exposure to the underlying asset while requiring a lower capital commitment compared to full-size contracts. Risk management, micro and mini contracts, and why they offer an alternative for smaller traders. Choosing between micro and mini contracts depends on the individual trading goals, risk tolerance, and available capital. Micro contracts can be an attractive starting point for the newcomer or those with limited funds, providing an entry into futures trading. Mini contracts offer a versatile option for traders seeking moderate exposure and flexibility. Understanding the difference between these contract types empowers traders to make well-informed decisions, optimizing their futures trading experience based on their unique preferences and strategies. The impact of contract size on trading strategies. Contract size significantly influences trading strategies, particularly with mini and micro contracts. These smaller sizes allow traders to customize approaches based on risk tolerance and capital, enabling precise risk management. Traders can use mini and micro contracts to engage the market with limited funds, controlling risk, or opt for multiple contracts to achieve exposure similar to, say, a standard contract, targeting potential gains. This choice shapes strategy execution, empowering traders to adapt, optimize risk, and align trading with financial situations and market goals. Scaling trade size with multiple contracts. One of the advantages of micro and mini contracts is the flexibility they offer in scaling trade size. Traders can adjust their position by trading multiple contracts to achieve the desired exposure. For example, if a trader wants to take a larger position in a particular market, they can use multiple micro or mini contracts instead of a single standard contract. This ability to use multiple contracts really allows traders to scale in and out of trades and manage their risk exposure. Module 4 has provided a comprehensive understanding of micro and mini futures contracts and their significance for smaller traders. These scaled-down contracts offer accessible entry points to the futures market and act as excellent tools for effective risk management. As you navigate through your futures trading journey, remember that choosing the appropriate contract size is essential for aligning your trading strategy with your risk appetite and capital resources. In Module 5, we will delve into critical aspects of risk management, an indispensable skill for any successful trader. Learn how to identify and manage risk effectively to protect your capital and achieve consistent profitability. Welcome to Module 5 of the Trading Floor's Futures Trading course. This module focuses on risk management and some of the nuances of futures trading. Throughout this section, we'll explore key aspects such as margin requirements, normal versus overnight, account sizing, ticks, and points. By mastering these techniques, you'll be better equipped to navigate the complexities of the futures market while safeguarding your capital and maximizing your trading potential. Let's get started. The importance of risk management and capital preservation in futures trading. In futures trading, and really trading overall, effective risk management and capital preservation are crucial. These principles ensure consistent performance, protect against losses, and form the foundation of a successful trading journey. Traders employ strategies like setting stop-loss orders, managing positions, and diversifying assets to mitigate risks. Recognizing the value of capital preservation, traders safeguard their initial investments, avoiding overleveraging and preparing for market uncertainties. By adhering to these practices, traders cultivate confidence, discipline, and a sustainable approach to navigating the challenges of futures trading. Let's dive into future-specific risk management, as there are some nuances to futures that you have to know in order to trade them safely and effectively. Calculating and managing risk, specifically margin requirements, normal versus overnight, and account sizing. As a refresher, margin in futures trading refers to the collateral required to open and maintain a trading position, ensuring that traders have sufficient funds to cover potential losses. Each broker has different margin requirements. In this example, I am showing the broker AMP Futures, or AMP Futures, and their margin requirements. Here, you can see the margin under the column Day Trading for normal trade hours and Maintenance for the overnight margin requirements. You can see that overnight hours or after-hours trading requires significantly more money in your account to trade during these times. Please check your broker's requirements for funding an account and requirements for trading with them. In this chart, you can also see both micros, labeled MES and MNQ, as well as the minis, ES and NQ. Again, micros being 1/10 the risk size of a mini contract. As such, the margin requirements for the MES and MNQ are 1/10 that of the ES and NQ mini contracts. One thing to note is that if you drop below the margin requirements, then your trade will be closed. So do not use these requirements numbers, the margin requirement numbers, as the amount you should have in your account. A simple example of account sizing: if you want to risk 5% of your account, and that is $100 per trade, then you take $100 divided by 0.05 or 5%, and you get a minimum account size of $2,000 to support a 5% risk trade, or $100 per trade. This is a really simple example, but that's how you can better understand your account size based on what you want to risk per trade. However, that's not all. In the Forex, price movement is measured in pips, but in futures, it's measured in ticks and points. Let's get into what those are. In the Forex market, price moves in pips, whereas the futures market is measured in ticks and points. Understanding the distinction between ticks and points is vital to risk management and position sizing in futures trading. A tick refers to the smallest price movement in a futures contract, representing the minimum fluctuation that price can make. On the other hand, a point is a larger increment and represents a little larger price movement. Ticks are fractional measures of points, with many futures instruments using the fractional value of 4 ticks to a point, or 10 ticks to a point. For example, in the context of the E-mini S&P 500 futures contract, a tick is 1/4 of a point. If the price moves from 5,000 to 5,025, that's 1 tick of movement. If price moves from 5,000 to 5,001, that is 4 ticks of movement, or 1 full point. Understanding how price movement is measured in futures is crucial to accurately managing your risk. Let's get into more examples. If price moves from 5,500 or 5,500 to 5,501, that is 1 full point or 4 ticks. So let's break down another example. The value 5,405 and 1/4 is 5,405 points and 1 tick. So a move from 5,405 and 1/4 to 5,406 is 3 ticks of movement. From 5,316 to 5,320 is 4 points of movement. Pulling it together, contract based on risk per trade. This is a discussion about how to calculate out the number of contracts that you can trade in any given market. I'm going to be using the ES or the S&P 500 as the example for this, but no matter which market that you're going to trade in, you're going to need to be able to do this type of calculation to understand exactly how much you're risking, and therefore, depending on how much you're risking, how many contracts you can trade. So if you're going to risk, for example, using the ES S&P 500, if you're going to risk $250, a mini is 1 point or $50, and 1 tick is $12.50. So there are 4 ticks to a point. The micros being 1/10 that of a mini, you're going to be looking at $5 per point and $1.25 per tick. As you can see, that's 1/10 of a full mini contract. Using that as a basis here and knowing that we're looking at the ES and we're willing to risk $250 per trade, let's look at how that affects the number of contracts we can trade based on the stop loss size that we're going to be using. So starting with 1 point of stop loss. In a mini, you have $250 divided by the $50 per point, your limiting factor being your $250. So if you take $250 divided by $50, you'll get 5 points of risk. That's the maximum stop loss size that you can use if you're risking $250. So if you take the 5 points of risk divided by your 1 point stop loss that you know that you're going to be using, that would mean you could use 5 contracts. 5 divided by 1 is 5. As you can see here, a micro is $250 divided by $5 per point, giving you 50 points of total risk. 50 points divided by a 1 point stop loss means 50 contracts. That should kind of be a given if you keep in mind that micros are 1/10 of a mini. Now, let's change that a little bit and say that, for example, you have a 5 point stop loss. Working with a 5 point stop loss, you're going to take that same $250, you're going to divide by that same $50 per point, and that's going to give you the same 5 points of risk. But now changing it up and knowing that you have a 5 point stop loss, you take 5 points of maximum risk divided by 5 point stop loss. That's going to tell you can risk exactly 1 contract within that $250 of risk. Being 1/10, micros comes out to 10 contracts. $250 divided by $5 per point, the 50 points of risk. 50 points of risk divided by a 5 point stop loss gives you 10 contracts, 10 times that of the mini, because the micros are 1/10 that of a mini. Okay, final example. Let's say now that instead of a 5 point stop loss, you in fact need 6 points of a stop loss. So in a mini, you're going to take your same $250 divided by $50 per point, telling you that the max you can risk is 5 points. 5 points divided by 6 points tells you that, shoot, I actually don't have enough to be able to risk a full mini contract. What that means is, in order to stick with your $250 of risk, you cannot use that mini contract. That's where micros comes in. It doesn't mean that you can't take the trade. It simply means that you have to scale your risk. It's the same as if you were trading in the Forex market, where you need to be able to scale the number of lots in order to meet your risk parameters. Micros allow you to do that. So if you can't risk a full mini, don't worry. You can scale your risk back until you are able to take the trade, and that's what micros is going to give you. So $250 divided by $5 per point tells us that we can risk a maximum of 50 points of risk. 50 points of risk divided by that 6 point stop loss means that you're going to be able to risk 8 micro contracts. That's what you're able to do for your trade. So you place your trade accordingly, knowing you're going to use a 6 point stop loss, place 8 micro contracts, and you fall right within your risk parameters. I hope these examples give you an idea of exactly how you're going to scale the contracts appropriate to your risk parameters and when trading futures. The same exact calculations apply. You're just going to adjust based on the market that you're trading. So if you're trading NQ, you would be looking at $20 per point on the minis and $2 per point on the micros. So knowing what market you are trading and how much risk it is per point or per tick, both in minis and micros, that'll help you to make these calculations pretty quickly. Now, pulling it together, account sizing, contracts, and trade sizing. So, how we pull this all together really does depend on your risk tolerances, the funds available, and what your strategy requires in order for you to take trades. Let's walk through one example here. If your risk is $250 per trade and you're on the ES, which is the S&P 500, you want to risk a maximum of 2% of your account capital per trade, and you are using a 5-point stop loss. Let's determine what our account size would need to be in order to support those parameters. For example, if you're willing to risk $250, and that is a maximum of 2% of your account, $250 divided by 0.02 will provide you with your account size minimum in order to take a trade that fits the parameters of only 2% of risk and risking $250. That answer is $12,500. That's the minimum that your account would need to be to support these risk parameters. Now, if we want to be able to trade one mini contract, then our maximum allotted points that we can risk in a stop loss is going to be $250 divided by $50 per point, or 5 points. So that does check out. If the stop loss that we need to be able to use is 5 points and we can risk a maximum of $250, then this trade would be viable for us to use one full mini contract. Now, let's take, for example, that the account that you're working with is, in fact, only $2,000, not the $12,500 that you would need. That would mean that you're risking $250 is not possible if you want to stick with the parameters of 2% of your account capital risk. So you would need to rescale to determine exactly how much you could risk in that case. So if you take $2,000 and you multiply that by the 2% risk, or 0.02, you will find that the max amount of monetary risk that you can do holding to that account size and the risk parameter of 2% is $40. Now, using that as a guiding principle here in our risk management, that we only want to risk $40, not the $250, since that's not viable on the smaller account size. If we have a one micro contract and we take $40 divided by $5 per point, because remember, the micros are 1/10 of a mini, then that would tell us that we can have an 8-point stop loss, meaning the one micro contract is viable for us to be able to take that trade underneath the risk parameters of having a $2,000 account risking 2%, giving us that $40. That means that one micro contract is viable, and we can take that trade with a 5-point stop loss on a $2,000 account. I hope this example helps you to understand how you need to take into account your account size and your risk parameters when sizing out the number of contracts, mini versus micro, that you can use in order to be able to take your trade in the futures market. Module 5 laid the foundation of risk management in futures, the importance, margin requirements, account sizing, and ticks versus points. With this knowledge, you better understand how to size your account based on a percentage or dollar value risk, and how many points you can risk based on the contract sizes, and how many contracts you can use in any given trade. In Module 6, we will discuss futures proprietary firms or prop firms and trading with your personal funds. Welcome to Module 6 of the Trading Floor's Futures Trading course. In this module, we will explore the world of futures proprietary trading firms, or prop firms for short, and how they can be advantageous for traders. Additionally, we'll touch on trading with personal funds and the process of setting up a trading account. Understanding these options will help you make informed decisions on how to access capital and begin your trading journey. Understanding proprietary trading firms and why would you use them? Proprietary trading firms, commonly known as prop firms, offer a unique opportunity for traders to access capital and trade on behalf of the firm. There are several compelling reasons to consider trading with a prop firm. First, it lowers your personal financial risk. By trading with a prop firm, traders can separate personal finances from trading capital. This lowers the financial risk associated with trading, as any potential losses are absorbed by the firm's capital rather than the trader's personal funds. Second, a small amount of money gains access to larger capital to trade with. Many prop firms provide traders with leverage, allowing them to access significantly larger trading capital than what they would have access to on their own. This leverage amplifies trading potential and the ability to pursue larger trading opportunities, as well as larger gains. 3. Larger gains from a smaller investment. With the increased trading capital, traders can potentially achieve larger gains even with a smaller initial investment. This offers the chance to grow their trading accounts more quickly than if they solely traded their own personal funds. We'll get into that a little bit more later. Futures prop firms. There are various futures prop firms available for traders. Each firm may have specific requirements and terms for traders who want to participate in their programs. Some differences to consider when evaluating each of the prop firms. For example, different prop firms may offer varying levels of leverage, different trading platforms, risk management guidelines such as drawdown, profit targets, max trade size, etc., and profit sharing arrangements. It's essential to thoroughly research and understand the terms before choosing a prop firm. What this means in futures. For leverage and risk management, that can mean the max number of contracts that you can trade with. Or the futures prop firm could have something related to scaling, meaning that you can only initially have a smaller position size until you've reached a particular account balance, and then you are able to scale in additional contracts. Trading platforms. There are 3 primary trading platforms for futures: NinjaTrader, Tradeovate, and TradingView. Many of the futures prop firms support these trading platforms, so you'll have your choice. Profit sharing. For the futures prop firms, most of them will fall in the 80 to 90% profit split. Another difference is payout amounts and requirements. This is a reference to the fact that several of the futures prop firms have a minimum number of trading days that you must complete before you can withdraw profits. This number varies between the different prop firms, so this is a particular thing of note that you should pay attention to when investigating which prop firm fits you best. Another key difference regarding the payout requirements is that several of the prop firms also have a requirement that they limit the amount of funds you can withdraw for the first 3 months. This is an additional factor that they use in order to try to help you to build consistency and to prove your longevity as a trader, as opposed to paying out on an initial profit amount that you've made and then having you blow the account. This is a common thing in the futures prop firm realm, so another good thing to take note of. Another significant difference that you'll find when looking at other prop firms versus futures prop firms is the profit targets and drawdown amounts that they allow. Futures has a much tighter amount of drawdown that they allow on the accounts. Another difference that you'll find between other prop firms and futures prop firms is the amount of profit target that they're having you shoot for and the amount of drawdown that they allow. Many of the other prop firms allow you to have, for example, 10 to 12% in drawdown, whereas futures prop firms, it's more in the 3% range. Even though it shows that you get, for example, $150,000 of capital, the amount of drawdown that you're allowed is much tighter and much smaller. This doesn't mean that you can't trade with it just as profitably. This just means that your risk management principles that you use have to be a bit more dialed in, and the amount that you risk is smaller. Proportionately, the profit targets are usually somewhere around the 6% range, as opposed to the 8 to 10% that you see with other prop firms. So these are some of the key differences. Let's get into my recommendations for futures prop firms. Recommended prop firms. Several prop firms have gained popularity in the industry for their reputation and trader-friendly programs. For example, TopStep, Apex, and Elite Trader Funding, ETF, are some of the prop firms that are popular and worth exploring. For example, TopStep has over 10 years in the futures prop firm industry. Apex Trader Funding has the deepest discounts. They regularly run an 80 to 90% discount, so they can be a cheaper prop firm to start with. Elite Trader Funding is another good option. It offers a variety of different types of challenge accounts. So depending on what you're looking for and find acceptable, such as a trailing drawdown account versus a end of day drawdown account, that being a main difference in the way that your drawdown is calculated, Elite Trader Funding offers both types of accounts, whereas Apex uses the trailing drawdown account type, and TopStep uses the end-of-day drawdown. There are, of course, many other futures prop firms. Please do your own research to determine which of these prop firms, such as TopStep, Apex, or Elite Trader Funding, may fit you best. But again, there are many others that you can investigate as well, each with their own set of different rules and requirements. Let's take a brief look at each of the recommended prop firms' websites. Okay, so I've already introduced you to the different trading prop firms that we recommend. And here I have Apex Trader Funding. I'd like to run through their website briefly and just show you a few of the key features that I think you should pay attention to, as well as where you can get assistance if you have questions. So up here is their help desk. You can submit questions here, as well as get assistance if you're in the middle of a challenge and are having issues. This is where you would be able to submit a help desk ticket. They also have a frequently asked questions up here. Let's jump over there. This is a large knowledge base where you can typically find an answer to any of your frequently asked questions, such as about Rhythmic, or, for example, about the trade copier, or their drawdown rules, or fees, or what happens when I pass a challenge, those types of questions. Right here, you can just type in and see if there's a answer to your question here. They also include a lot of videos. It's pretty extensive collection. If you don't find an answer to your question, you'd like to reach out to them, you can go up here and just submit a request. They're pretty easy to get a hold of. Okay, back on the homepage, let's scroll down here and see a few details. You can see they clearly make a lot of payouts. They are a very popular futures trading prop firm because they do frequent discounts. 80 to 90% off. If you provide them with your email address, you'll be able to find out when they're running these discounts. Usually about every 4 to 6 weeks, they run a discount. Let's scroll down here. You can see a why to choose to trade with them. So one of the things that's kind of unique is that they give you 100% your first $25,000 that you earn on your account, and it's a 90% profit split after that. That's pretty darn good. Great way to take your first 25K and fund a personal account for trading futures. The next thing is that they do payouts twice a month. They have a minimum of 10 trading days in order to get a payout. That makes it, of course, a maximum of 2 times per month. You can qualify in as little as 7 trading days. So they do have a minimum number of trading days once you've reached your profit target. If it hasn't been 7 trading days, then you have to put in small trades in order to reach that goal and fulfill that requirement. They don't have any type of daily drawdown. They just do an overall drawdown, which you'll see in the specific account challenges later on in the website. But their daily drawdown is a trailing drawdown, and that's something to be aware of. They do have that distinction that it is trailing based on each trade taken instead of at end of day, like, for example, TopStep does. They do allow you to trade holidays should you choose to do so. And to be clear, they are a one-step evaluation process. All of these futures prop firms are one step, not 2. And another distinguishing factor for Apex is the fact that they allow you to have up to 20 accounts with them so that you can get a lot of capital with this prop firm. And you can use a trade copier tool in order to link them together should you choose to do so. Okay, and scrolling down here a little bit further, you'll see that they highlight minimum trading days, one simple step, trailing threshold, key things to pay attention to. And then you'll also see here that they're going to list out the account sizes that they offer. It's a lot of funding when you get 20 of these different accounts. Again, the amount that they list here, that is the fee, is basically their full rate. They do offer the discounts every so often. 80 to 90% off is pretty typical for them. They offer two different options, Rhythmic with NinjaTrader. They also offer Tradeovate, which you'll see further scrolling down this page. Depending on which platform you're most comfortable with, you would just choose that specific option here, NinjaTrader or Tradeovate. So looking at this is a 50K account. You need to pay attention to the number of contracts you can trade, 10 minis or 100 micros. They have a specific profit goal. This is one of your targets. The other thing you have to pay attention to is your trailing threshold. You need to be aware of this trailing threshold, as it is the thing that would cause you to violate the account. Otherwise, presuming that has not been hit, you have an unlimited amount of time in order to try to hit your profit goal, so long as you keep paying the monthly amount. They offer everything from a 25K all the way up to a 300K account. Again, you can get 20 of those. That's a lot of capital. And here, scrolling down, you can see the Tradeovate options as well. Okay, this is the Elite Trader Funding ETFs website. Similar to Apex, you have the frequently asked questions up here. They also have a Discord community that you can access. Let's take a quick look at the frequently asked questions. Down here, it's pretty simple. They also have a help center. Here, similar to Apex, you can search for your answers. It's a pretty extensive collection of articles and videos explaining different policies and programs and, well, just your common questions. Also similar to Apex, you get to keep 100%. In this case of your first 12,500, Apex was 25,000. That's just a little bit of a distinction on that. But again, this is a large chunk of change if you can earn it through your funding, and it's great to start a personal account for trading futures. After you've gotten that 100%, it switches to 90% of your profits. They also offer pretty cheap resets of your evaluation account, and you can trade up to 20 accounts as well. So again, this is another option where you can get a lot of different funding through this futures prop firm. They also allow you to trade through NinjaTrader, Tradeovate, and they have the TradingView integration as well. So you really can choose any of the 3 different trading platforms that I mentioned. So this is really, really good option for you to be able to trade whichever one you are comfortable with. And if you are specifically wanting it to be as easy as possible to trade the TTF indicators, then TradingView would be your better option in this case, as you can trade the prop firm's money directly from TradingView with the TTF indicators. Okay, and scrolling down a little bit further here, we're going to take a look at the different options that they have. Their one-step evaluations. They do have a few different ones, some that involve the intraday unrealized trailing drawdown, which is exactly how Apex does it. They also offer accounts that are based on your end of day drawdown, which is how TopStep does it. So this prop firm offers both options. So pay attention to which one you're looking at. Again, they have a lot of different options for size of your accounts, 10 all the way up through a 300K evaluation size. So that is a lot of different options here, as well as the fact that you can have up to 20 accounts with them. That is a lot of funding. Here you can see the max number of contracts that they will allow, minis versus micros, your profit target that you need to aim for, and your trailing drawdown. Again, very similar to Apex and to TopStep, how they treat that. They are also very open here that it's $80 a month once you have a funded account. That is a reoccurring fee that you pay in order to have access to their funding and to pay for your data fees. Here they say that this is how much it costs every 30 days. They, again, do not have a limit on the number of days that it takes to pass the challenge. You'll just be charged a reoccurring monthly fee for each one of your evaluations. Okay, scrolling down a little further here, these are the end of day drawdown evaluations. So instead of your trailing drawdown based on every single trade and every dollar that's changing within the trade, it is based on an end of day evaluation. And this can be something that you should consider because it does affect potentially the way that you trade. Again, same size accounts available in this end of day drawdown set of rules. So just choose which type of drawdown that you want to be able to trade with. And then they also offer fast track evaluations. Okay, and this is Top Step. As I mentioned before, they are the longest running futures prop firm, as they indicate here, over 10 years. They also offer very fast payouts, and they have done a lot of payouts as well. So they're a pretty good, reliable prop firm. So I'm going to scroll down a little bit further here. They have one rule very similar to the others. You're trying to hit your profit target, and you have a specific overall trailing drawdown that you need to be aware of, and that is the only way that they're saying that you would violate the account challenge. Scrolling down a little bit further here, you'll see that they offer 3 sizes of challenges, so that's a little bit different than Apex or ETF. They only have a 50, 100K, or 150K challenge account. They also offer only 3 accounts with them, not the 20 that the others do. So again, this is a really great option for you. You can consider here, they say the profit target, the max number of contracts. They do not distinguish between micros and minis. So it is a little bit harder to do something along the lines of scaling with them. So keep that in mind when you're looking to trade with them, as well as here is the maximum loss limit that you have. So this would be your overall only thing that's going to violate your account according to them with their one rule account challenges. So if we look at how their challenge works here, we're going to say explore how it works. This will take us over to a little bit more about their trading combine and their max loss limit rule. They also give more information about profit target, consistency target, and your daily loss limit. When you click on read more, they have a very nice resource center that it takes you to. This is underneath the How It Works Futures Trading 101. They, again, have a very extensive amount of information. This is about the trading combine parameters, but you can also back out up here to trading combine, which gives a lot of details about the trading combine. And then if you back out one step further, here are popular topics about Top Step itself. So this can be a lot of great information to answer your questions. They are also very, very responsive to any questions that you have. So you can send them an email, for example, or call them up and ask your questions there. And they're quite helpful. So they have a lot of information about trading with their platform, which would be Tradeovate, and they have NinjaTrader as well. So you have both of those different platforms that you can trade with, and they don't distinguish fee or account type for that. As you can see before, they had the 50 to 150K funding. Both of those options are available through Tradeovate and NinjaTrader. So I hope the details about the different prop firms, as well as the quick view of each one of their websites, will help you to navigate and find the answers to your questions, as well as a few of the key details about what you might be looking at with each one of the different prop firms, and will help you to make the decision about which prop firm best suits you. Let's dive into trading with personal funds and setting up a trading account. If you prefer to trade with your personal funds, setting up a trading account with a reputable broker would be your next step. Here are some considerations. Ensure that you have sufficient capital. Insufficient funds can lead to over-leveraged, high-risk trading and blown accounts. If you lack significant funds to trade with, please consider using a smaller amount of capital to purchase a prop firm challenge. Once funded, you can grow the personal funds you need to trade your own capital. For example, in futures, $20 isn't enough to fund an account, and $300 doesn't really give you much room for trading with a single micro contract, leading you to over-risking. Instead, with that $20 to $300, you can purchase a $50,000 to $150,000 prop firm funding account. And if you pass their challenge, you can then grow additional funding for your personal account. I'd say that's a pretty good return on investment right there. Also, I do not recommend you trade many contracts with less than $10,000 in your account. With less capital, you should look to trade micros contracts. My recommendation is at least $1,000 in your account to trade with one micro contract. However, Please do your own risk management calculations and verify your broker's requirements for funding an account. Recommended futures brokers. I have experience with the popular brokers AMP Futures, NinjaTrader, and Tradeovate, and they are all good choices with very little variation in trading fees. They offer user-friendly platforms, competitive fees, and reliable customer service. Here are a few highlights. AMP Futures is an inexpensive broker, and they have the benefit that they integrate with TradingView. So if you're used to using TradingView to do your charting or there are indicators that you use that are part of TradingView, this would be a good option for you. The second one is NinjaTrader. They are both a software platform and a broker. They have the added benefit that they offer a lot more backtesting data available to download. So in TradingView, you have a limited number of bars that you can go back in order to do your backtesting. NinjaTrader offers you years worth of futures data that you can perform your backtesting on. They also do their backtesting in a bar replay mode that provides you with second-by-second formation of the candles, giving you a much more realistic backtesting session and experience with how the market was playing out on any given day. The third option is Tradeovate. It is a browser-based platform. They also have a mobile application for trading with, and they are a broker. They too are linked into TradingView, making them another great option if that's the way you're used to trading. Let's take a quick look at these brokers' websites. This is the website for the NinjaTrader trading platform as well as the broker NinjaTrader. Let's take a quick look. Up here they have a few resources regarding futures, futures basic, and some general resource material around learning about futures. Over here they have information about their platform. They have a desktop software that is the primary trading platform that NinjaTrader offers, though they have recently released a web browser-based platform and a mobile application with the acquisition of Tradeovate. Here on their website, they offer a quick overview of their platform. Scrolling down here, they get into the fact that they are a desktop platform, and here they show their browser platform, which will look very similar to the Tradeovate web browser platform as well as the mobile application. Here it emphasizes again that it is free. They do have customizable software, a lot of indicators that are available through their platform, as well as the ability to create your own customized indicators. They offer a lot of order flow tools, which is what they're showing here on this chart example. They have chart markup tools in their platform as well. Here on the website, you can see that they are talking about their simulator. That allows you to do real kind of live streaming of previous data, as well as if you have an integrated market data feed, you can do simulated real-time trading. So a demo environment, so to speak. This part of the site emphasizes the fact that they are a free platform, though you do have to have that integrated data feed. They are a broker, so you can purchase that through them. They emphasize that they are cheap in their contract commissions, as well as requiring low margins. All of the brokers that I'm suggesting have, again, very, very similar commissions and margin requirements. So something a little bit different with NinjaTrader than the other platforms like TradingView and so forth is that they have different tiers to their desktop software licensing. And with that different licensing, you get different commissions on each of the contracts that you trade, both what they show here, micro, and what they're referring to as standard, that is a mini contract. And when it says commissions per side, that means if you buy a contract, that's one side. When you go to sell that contract, that's another side. So here they're showing you the starting fees. Not every one of the different types of instruments that you trade will have the exact same fees per side. This is usually just a starting rate that they use as their base rate. So a lot of the fees are dictated by both the broker, and the CME has its own set of fees in order to place trades through their marketplace. So here you can see, like I said before, the free, monthly, and lifetime does change the amount of fees that you pay. And you can see down here, no monthly plan fee. They do have this free option, so you don't have to pay a fee outside of the data fee in order to get started simulated trading and trading in the market. But they do also offer a monthly fee, which buys you cheaper commissions per trade. These commissions are listed as per side, so that means when you buy a contract, you're going to pay, for example, with a mini, which they list here as a standard, you're going to pay $1. When you go to sell that contract, you're going to also pay another $1. So it would be $2 round trip is how you can think of that in order to fully place and exit a trade. You can see here with their lifetime, they also give you lower commissions, but they also have their order flow suite of tools and some other add-ons that become available when you purchase a lifetime license with them. That lifetime license is a one-time payment as opposed to a monthly fee that you see here. Okay, now we're going to look at their commission rates, and I'll show you that that gives you the details that you can look up exactly which instrument, for example, like the NASDAQ, so NQ that you want to trade, you can look up the exact commission rates there. It opens up this PDF. You can see here itemized fees, all-in rates, and then they break it down lifetime, monthly, and free to show you exactly what you would be paying, as well as the margins required. Now they list intraday here. That means during normal market hours. As we discussed before in a previous video, there are different rates or different margins that you need to have in your account in order to cover the overnight market trading. So for example, if you want to be able to trade the NQ, so the NASDAQ futures here, you can see the broken down cost right here, and then you're all in. If you're trading their free platform, you're going to be paying $2.79 per side. Okay, so that means that you're going to be looking at just over $5 for each trade that you place. As I showed you before, there are a lot of different products you can trade. Here you can see cryptocurrencies, you can see agricultural products, and you can see the Forex market pairs that you're available to trade through NinjaTrader. Now on to the next platform. This is Tradeovate. They are both a platform and again, a broker, okay? They offer very similar fees and setup to what NinjaTrader has, except that they are strictly a web-based platform and a mobile application. They allow you to chart and to put indicators on your chart. You can place trades so long as you have that exchange data feed. So here you can see when you drop down on platform, Tradeovate offers the mobile trading application. You can download their trading application, so they do run it in a desktop-based platform as well, though primarily through the web browser. Here I'll do a quick scroll through. Their biggest emphasis with Tradeovate is they allow you to trade anywhere. So you're not locked into just your desktop. You can pull up your browser anywhere, like on your mobile phone, to check your trades or to place trades. Really quickly, they're showing that they have depth of market if that's something that you're interested in trading the DOM. Again, they have charts. You can add indicators to it, different types of charting. I had mentioned the advanced order management. This is the brackets that I was speaking about that allow you to, when you place an order, it'll place the stop loss and the take profit as well for you. They do simulated trading and market replay as well. So this is a good option when you want to practice your trading skills. Now over here on pricing, you can see that they offer a free option, a monthly and a lifetime fee as well. Since the acquisition of NinjaTrader of Tradeovate, these fees now match what NinjaTrader does because they're a very similar platform, though Tradeovate's focus is more on the web-based and mobile-based application. And their charting platform does look different than the NinjaTrader desktop-based platform. Their commissions and fees should look very similar to NinjaTrader. And here you can view all of their commission and fee rates. So here you can see all the different products. These are their all-in rates similar to the NinjaTrader platform. And again, if you're interested in trading the NQ NASDAQ, you can see that right here, lists out the individual fees, commissions, and then your all-in round trip fees. And lastly, here we have AMP. AMP is not a trading platform. They are just a broker. The trading platforms that they support integration with are listed right here. You can see that if you are really interested in trading with MetaTrader, They are one of the only ones I know of that does have an integration with MetaTrader 5. Though the primary integration that most people will be using is through TradingView, because this is the integration that allows you to use the TTF indicators in your trading. We'll be getting more into that later on. Their fees are going to be very similar to the other brokers as well. So here underneath trading info, this is where you can see the margins that they require you to have in your account in order to take trades. They also get into the trading hours specific to each one of the instruments that you may be interested in trading. They get into contract expirations as well, which can be helpful because the contracts do change over each quarter, and they have a very specific changeover period depending on the specific instrument. They also get into holiday hours when the market is not open. Let's take a quick look at their margins. This chart should look familiar. This is what I pulled over into the course. It very clearly spells out this is day trading, which means normal market hours, and the maintenance, which is your overnight market hour requirements per contract that you trade. This is micros here, MNQ. Down here is the E-mini, so NQ, and the requirements for trading that. Here is a great reference, tells you that the market, for example, for the S&P 500 opens at 5 p.m. and closes at 4 p.m. Here are the market hours for each of the different instruments that you can trade through AMP. AMP, Tradovate, and NinjaTrader, all of those are brokers, as well as NinjaTrader and Tradovate being trading platforms, but they all tie into the exact same trading exchanges from the CME group, and they do offer, as a result, the same exact instruments that you can trade. Contract expirations. So here you can see the tick value. Also, I did pull that in to the course, so you can see how much each tick is worth in the MNQ, and in the NQ here you can see that each tick is worth the $5. This also lets you know that the contracts expire quarterly. Okay, though AMP Futures tells you that you need to contact them to get a quote on commissions, I'm going to show you how to access an estimate of the fees that you would pay in order to trade through them. Okay, so if you go to this website up here, portalampclearing.com, account commission quote, this is a little calculator you can use to better understand how much AMP Futures charges for trading through them as a broker. So here you would just say CQG. That is the most common one, though Rhythmic is also a common integrator for your data feed, though that is more often through the prop firms that use Rhythmic. CQG is a very common one. So we're going to use CQG. We're going to select our platform here as TradingView. Version doesn't really matter. Down here we can scroll down and we can see here that we have the micro S&P 500, and you can see that round turn, so they give you per side and round turn here, so you don't have to do the calculation. It's $1.20 per contract with them. Micro for the NQ is $1.20 as well. And the full E-mini NQ, you can see right here, is $3.90. So that's a quick run through of each one of the broker websites. I hope that gave you guys some good information about what each broker offers as far as services, some of which being trading platforms as well, and a quick way to see their margins and the cost to trade through them. The best resource you have is their website and reaching out to their customer service. So I suggest you do that if you're interested in using them as a personal broker platform. Later on, I will be showing you how to use TradingView for demo trading, so stay tuned for that. But wait, I'm outside the US. You might be wondering if futures, specifically the U.S. futures markets, can be traded outside the U.S. And are there any brokers? Yes, futures can be traded outside the United States. Different brokers have different requirements for funding, identity, proof of residence, that type of thing. There's too many variables for TTF to make a recommendation, so please do your own research. Reach out to each broker's customer service and ask if they support customers from your country. This specifically applies to personal account funding for the brokers that I listed above: AMP Futures, NinjaTrader, and Tradovate. Futures prop firms are different than these personal funds brokers and are pretty straightforward for most people to trade with. Whether it's trading with personal funds through one of these brokers or a futures prop firm, it's safest to reach out to their customer service and ensure that they can support you. Module 6 has provided insights into the world of futures proprietary trading firms and the benefits they offer for accessing capital and managing your risk. We've also explored setting up trading accounts with recommended brokers for those choosing to trade with personal funds. In Module 7, we will focus on trading platforms, a fundamental aspect of futures trading. Trading platforms serve as the gateway to the markets, enabling traders to execute trades, analyze market data, and implement various strategies. Understanding the features and functionalities of different trading platforms will empower you to make a better informed decision about selecting one that best suits your trading style and preferences.